QYLD used to be one of the hottest income ETFs on YouTube, but now there's a new dog on the street that boasts a yield of over 7 times that of QYLD. Famous investors have warned against the dangers of over-diversifying, but this ETF only invests in one underlying asset, so surely they can't be over-diversified. And of course, the ETF that I'm talking about is the famous TSLY YieldMax ETF, ticker symbol TSLY. And in this video, we'll discuss the objectives and investment mechanics of TSLY and look at some of the pros and cons and whether I think this could be a good choice or not. At very first glance, TSLY looks like a dividend investor's dream. With a forward dividend yield of 87% and a trailing 12 months dividend yield of 68%, what could possibly go wrong? Some people might be excited about this high dividend yield, but that's an instantaneous red flag for me. Dividend yields of this magnitude are unsustainable and dangerous in pretty much all cases, but let's keep an open mind for now and take a closer look at TSLY. In the prospectus, we can see that the fund's primary objective is to seek current income, and it also has a secondary objective, which is to seek exposure to the share price of Tesla stock, which is subject to a limit on potential investment gains. And the fund uses options to execute towards those objectives. Specifically, they use a synthetic covered call strategy to collect income and participate in limited upside from Tesla price appreciation. So let's break that down a little bit more. In a traditional covered call strategy, an investor in some underlying asset, in this case Tesla stock, will just sell a call option on that underlying security and collect some income. However, in the case of TSLY, they don't actually own any shares of Tesla stock, and this is where the synthetic covered call comes in. So what they do is they synthetically replicate the price of Tesla stock by buying a call option and simultaneously selling a put option, and this is a well-known strategy to create what's called a synthetic long stock position. And the difference here is that typically it requires less capital outlay for a synthetic long stock position than it does to just buy the stock outright because of margin requirements. And oftentimes when you sell a put, it's not going to be fully cash secured. But the caveat there is that the investor is exposed to pretty much all of the upside and downside risk. And then after the fund creates that synthetic long stock position, then they can sell covered calls like normal to generate income. So the prospectus has a fair amount of detail when it comes to exactly how and when the ETF is going to enter into these specific option trades. So for the synthetic long stock position, they state that the buying of the call and selling of the put, those are going to have expiration dates of 6 months to 1 year out when they create that position. And the strike prices for both of those options are going to be the same, and they're going to be approximately equal to the share price of Tesla at the time that they open that position, essentially. And for the short calls, they are generally going to have an expiration date of about 1 month out, and the strike price is going to be between 5 and 15% above the share price of Tesla at the time that they sell that call. So to get a clearer idea of everything going on, let's take a look at a hypothetical trade in Thinkorswim that mimics exactly what the TSLY ETF would do. So on January 24th, when I did the research, the stock price of Tesla was about $210. Funny enough, today, the next day, the stock is down about 10% to around 190. But it doesn't really matter all that much. We'll just stick with the 210 numbers, and it would be a pretty similar situation. This is just an example to give you an idea of what might happen. So if the stock price is around $210, then for our long call and short put, we're going to choose the $210 strike price. And I chose the December 20th, 2024 expiration date, which is just less than 1 year out, which is what TSLY pretty much said they'll do. So to buy the call, this will cost us about $4,250, and then to sell the put, we'll receive about $3,240 of premium. So the net cost to enter this position of a long call and short put will be $1,010, and that'll use up $21,000 of collateral as well, which may or may not be the full amount of collateral that TSLY has to use. Most likely, they're going to have to use a significantly less or smaller amount of collateral, which allows them to enter this position for essentially a lower cost, if that makes sense. And then for our short call, I chose the strike price of $230, which is about 10% above that price of $210, which is midway between the 5 to 15% guidance that the prospectus gave. And I chose the February 23rd expiration date because that's just about a month away. And for selling this call, we will receive about $555 in premium. So this graph here is a handy little graph that Thinkorswim can create for you to show your profit and loss at the expiration date at different prices. So the blue line here is the profit and loss on February 24th, which is when the short call will expire. So if Tesla's price goes down some, then we will lose some on the synthetic long stock position, but that will be covered by the amount of premiums that we collected for the short call. But our break-even price, as we can see, is about $206, which means if Tesla stock goes below $206, then the premium we received from the short call is less than the amount we lose on the long stock position. So that trade is kind of in the negative. But that's also not really the biggest deal because on February 24th, when this short call expires, we will still own that long stock position for a long time. So we can go out and sell another call and collect more premium. On the other side, if the price does go up some, then we still get to keep all the premium from the short call, and then the synthetic long stock position is profitable. But if the stock price goes above $230, which is the strike price of the short call, then we will have to buy back that short call for a loss, and that loss will be equivalent to any gains past $230 for the synthetic long stock position. So our max profit for this trade is about $2,400 if Tesla stock is at $230 or above. So ideally what we would want is we would want the price of Tesla stock to be just below the price, the strike price of that short call, so that the call expires worthless, but the synthetic long stock position gains the most, and then we can sell another call for the next month. So theoretically, I do think this strategy for selling covered calls seems to make sense, but there are some major issues, two in particular, that I'm not really a big fan of. So firstly, using that synthetic long stock position creates more leverage and more risk that doesn't really seem necessary to me, since Tesla is a quite volatile stock and the premiums are already fairly high on it. So in that case, I don't really see the point of, adding more leverage instead of just, owning the stock and selling that synthetic or traditional covered call on that stock. Additionally, having such a formulaic approach to selling the short calls is not nearly enough of a nuanced approach, in my opinion. So if we remember back when Tesla stock was in the low $100 range at the end of 2022 and the beginning of 2023, well, any real long-term investor that knows something about Tesla stock could probably figure out that that's really not the best time to sell a covered call 5 or 15% out of the money, because it's not really going to take much at that point for Tesla to have a big run up, and then it's going to blow past the strike price of your call, and then you're missing out on a lot of gains that you would have had if you had just invested in Tesla stock and not worried about the covered calls and trying to generate income. And sure, Tesla is a volatile stock, so like I said, the options premiums are higher on it than other stocks, but Tesla has also performed very well. So in my opinion, it seems like the likelihood that it shoots up and blows past that short call strike, or even crashes way down below your break-even point, is much higher than the likelihood that it kind of just meanders around a little bit and goes up a few percent each month like you ideally want it to. So I think this strategy could work well if you maybe did it on your own and weren't forced to provide a monthly distribution and sell calls every single month. But because TSLY has to pay a dividend every month, they pretty much are forced to put on some covered calls every month, even when it might not be a great time to do so. And we can see these problems creeping along. The TSLY ETF was started in November of 2022, and it's down 51% in that year and 2 months since the beginning. And even with dividend payments, TSLY still has had a negative return since inception, and it's lagged both Tesla and the S&P 500 significantly. And generally speaking, the dividend payments have shrunk a little bit in that time frame rather than grown. So yes, I think TSLY does look fun and trendy, and maybe it looks like you can make a lot of money in the short term, but for anyone that's serious about investing, it really looks like a serious yield trap to me that is on its way to honestly completely blowing up. And on top of that, it has an absolute killer expense ratio at 0.99%, which is very high for any ETF or mutual fund. So as you may have guessed, I'm not a fan of TSLY at all. I think it's honestly a pretty bad investment, at least for me and my goals. Maybe if your goals and style or something in your life is different that makes TSLY make sense, I'd love to hear why. And if it works for you, that's fantastic, but definitely not something I would recommend to a lot of people. But if you do want to chat more about TSLY or any other stocks, ETFs, or the stock market in general, I'd love for you to join my free Discord server, which will be linked in the description. Thanks for watching to the end of the video, and I'll see you all in the next one.